Hi, everyone. You don't want to miss this episode. We're going to dig into private lending, and we're going to talk to a private lending expert, Kyle Ford, and we're going to talk about what kind of returns do you expect, how do you set up a deal, and we're going to go through actual numbers of private lending. Hi, everyone. Welcome to Control and Compound with Darren Mitchell. I'm your host, and joining me today is Kyle Ford from Kyle Ford Mortgages. Kyle, how are you?
I'm well, Darren. How are you today?
I am doing fantastic. Kyle, we go back a fair ways. I remember back in years ago, I joined a real estate group, and you were part of that and helped me go through that process. So, and then I just saw you a couple months ago at another real estate conference, and your name is everywhere. You have business that's just booming for you. Welcome to the show.
Yeah, thanks for having me, and it's great that we connected again a couple months ago, and happy to be here and share what I can.
Okay, so we're going to talk about private lending, and we've talked about this in the past, but we get a lot of questions on this from listeners saying, okay, I kind of understand it. And, my second book, I wrote a chapter on private lending with infinite banking. But I want to dig it into it because, Kyle, you live and breathe this stuff. You're an active real estate investor yourself, and you're a private lender. So I want to talk about your real estate just briefly, and then we get into the private lending, because at Control and Compound, we are all real estate investors working with real estate investors to help them implement the infinite banking concept. We like dealing with people that are real estate investors for our listeners too. So tell me, what do you got on the go for real estate right now? I know you had a fairly large portfolio, but you're pared it down a little. What's keeping you busy?
Yeah, so it's crazy when I say this number out loud, but I've been investing in real estate for a decade now, 10 years. I started small, pre-construction condo, single-family rental, scaled up to small multis, flipped a bunch of houses, large multis. Then I got into the cottage business. We have a small hotel. And then from there, we've got into large scale land development. I'm in the process of flipping a site plan approved 8-story building. I'm also involved in a 18-acre subdivision. Large scale development, multifamily, cottage rentals, hotel. And my favorite thing now as I try to pivot to more of the passive model of real estate is the private lending side of things.
That's awesome. Wow. Congratulations. That's quite a track record on real estate investing. That's awesome. All right. So let's talk about private lending. What is it? Bottom line, you get someone that needs money and someone that has money, and then we need someone to bring them together. At the end of the day, is that really all we're talking about?
Yeah. And I think this is specific to my practice, but I believe relative to your show as well, is there's two types of private lending in my world. There's consumer lending and investor lending. And if you talk to most mortgage brokers and say, hey, I've got some money, do you have a client? They often will. And typically that's a consumer situation. A couple that's got into a little bit of trouble, they're behind on their bills, the husband lost his job, wife's not well, whatever that story may be, and they need a private mortgage to help bridge that gap. That's what most people think of private lending. Where we work is a little bit different, and that's the investor space. Our clients are generally high net worth, usually high business income, maybe not a high T4, but high business revenue, and they're not borrowing your money because they're in a distressed financial situation. They're borrowing your money because they know how to make a higher rate of return than that which they are borrowing at. So the investor versus consumer lending is really a key fundamental difference when it comes to where you're lending your money and who's borrowing it.
And was that just because you're an investor yourself, or you found the likelihood of getting that loan repaid increases when you deal with an expert who does this all the time and does multiple deals, as opposed to a couple in financial trouble?
Yeah, it's a great question. There's several reasons. First, absolutely. First of all, I love the business to business. We're dealing with another business owner who's not just desperate for money, but they have a pro forma that they're reading off and saying, hey, listen, I can afford these rates. I can afford these fees because look at my profit. When you're dealing with the consumer side, I often call it, and this might be a bit extreme, but Band-Aids on bullet wounds. Because often the truth of the matter is this couple that's got into this distressed scenario, they need to sell their home. They can't stay there anymore. They can't afford it. And putting a private mortgage on it is delaying the inevitable, which they likely need to sell the property. Now, where I really don't like that side of the business is it can be very emotional. You know, they're like, we can't make our payments, but can you delay the power of sale because our kids aren't done school till June? And, you know, I have a heart. I don't feel good about that process. But if I have a client's money in, unfortunately, business is business, and we need to force that sale right away. So I really don't like the emotional side of it. I don't want to be in the business of kicking families out. And in our experience, the default rates are significantly lower on the investor side, dealing with professional people who are using your money as a tool in their business, as opposed to a Band-Aid on a bullet wound. I'll go back to that reference.
Yeah, no, I love that. That's a great description. So if you're dealing with investors that are successful, you know, making good money, have a lot of assets, why can't they get a regular loan? Why are they coming to you and saying, I want to borrow money at a higher rate? Why are they coming to you?
Yeah, great question. Several reasons. One of the biggest thing is speed, timing. If anyone's gotten a mortgage lately, you know, I'm a mortgage broker, but I don't have the secret sauce. We need a ton of documents, and it takes a lot of time. There's just no ifs, ands, or buts about it. If you're a normal couple who wants a white picket fence and a house with 2 T4 jobs, we can get you a mortgage in 2 weeks. But if you have 5 to 10 properties, it's months. And the truth of the matter is the A lenders, the big banks, don't really want your business. They don't really want to give you your 8th mortgage. It's you're a different risk tolerance than the residential portfolio that they have, and they really don't want to give you more financing. So speed is one. The other big one, and not a lot of people understand this, is condition of the property. When it comes to A-rate financing and getting that low-cost money, the lender requires that the property is what's called habitable. So it's in good shape. The night of closing, you can go there, you can sleep in a heated home, you can wake up in the morning, you can use the toilet, have a shower, cook yourself breakfast. Well, as a real estate investor, I know that I don't want to buy those houses. I want to buy the dilapidated house that needs the work. That's where I can get a rate of return. So the banks don't want to finance often because of the condition of the home. So if the major risk in these scenarios as a lender is around execution. Can the person who is borrowing your money, the borrower, go in and do they have the track record to renovate, increase the value of the property, and exit and sell? So the speed, condition of the property, and often, generally speaking, if the condition of property is good and they have time, if the real estate investor that's borrowing the money has 10 properties, the bank's just not, you don't fit in their box anymore. You're not in that box. And if you want to go commercial financing, generally the loan to value is quite high, that it requires a large down payment. And as a real estate investor, we're generally trying to put less of our own money to do more deals.
Great, that was a fantastic explanation. All right, so that's the person borrowing money. We get a successful investor that's done this before, has a track record. Which you just said that the bank doesn't want a loan, and I'm like, so let's see, this man or woman did a successful real estate transaction, repeated it the second, third, fourth, now 10 times they've gone in, they fixed it up, they made it nicer, refinance, and now, well, congratulations, you're really good at what you do and very successful at what you do. We don't want to loan you any more money for that. It is a little crazy backwards, right?
It is. My life philosophy is don't do as the banks say, do as the banks do. You could be the bank. Yeah, we talk about that all the time. We want to be the bank. We don't want to use the bank. That's right.
So what about the guy or the woman lending money? Who are they typically? Where do people say, hey, great, don't deal in traditional lending or traditional investing or RRSPs. I want to do private lending. How do those people come out of the woodwork?
Yeah, so it's not Bubba the loan shark down in the back alley driving a blacked out Cadillac. This is what I like to call Bob and Mary homeowner Canada. They're driving, a nice Honda Accord and a Jeep Wrangler. They live in a nice home that they've worked hard to pay the mortgage down on, and they've done the quote unquote right thing by saving money and nestling it away in their registered plans, etc. So those people generally become educated in real estate and how that they can do different things, and they use that equity via a cash out refi or a home equity line of credit. They move their registered plans to a self-directed trust company, and they now become the lenders. They're the lenders. So home equity is a big one. Registered plans is a big one. I give this tip out all the time, so it's not a big secret, but it's been one of the one area that I've gotten a ton of capital from is holding companies of successful manufacturing, construction companies, doctors, lawyers, etc. Successful business owners that have holdcos, a lot of them have a ton of cash sitting there that they don't know what to do with. Half the time they're just putting it in GICs because they don't even know what they're allowed to do with it. So talking to those people and showing them that they could lend on secured mortgages is where I've been able to attract a ton of capital from.
In a holding company, though, if you get too much passive income, if you still have an operating company, that can set you offside. But there'll be guys with holdcos. Yeah, I mean, you get the first 50,000 in your holdco is good. After that, it gets a little dicey on taxes. But there's all kinds of strategies. That's interesting. Holding companies. Okay, so the next thing
operating companies as well. Like the
yep.
business owners who are sitting on retained earnings. They're first of all, they're business people, so they're open to an idea. They're generally not closed off to this. A lot of them not only have made money in business, but they've underlying bought a building, bought a shop, bought a office downtown, and they own a home. Maybe they have a cottage. Like, they've done well on a real estate too. So when you start talking to them about this, they're not like, ooh, real estate, I'm not sure about that. Maybe they made their money in manufacturing plastics or windows or doors or construction, but they still understand the underlying value of real estate. So it's not this far out conversation with them.
Yeah, no, that's great. Okay, so we got all kinds of players in this, and sometimes, people, there's a borrower and a lender. But there's a lot more players to this. So if we want to break down who would be the players in a typical deal, like how many people guy wants to borrow money, guy wants to lend money, and how many people are involved in that transaction?
Yeah, so we have the borrower and the lender. So we need two sides to this: somebody who's got the money and somebody who needs the money. What I do as a mortgage broker, or if you're looking for somebody to do this, you find a mortgage broker in the middle of this. Even if you know somebody really well and you can put the deal together yourself, you guys can use lawyers to do it on your own, and you don't need a broker. But in my experience, what I found is, first of all, from a lender perspective, it's really good if you're not experienced analyzing deals, underwriting them, looking at appraisals, looking at loan to values, etc. It's really good to have a financial professional. And what I found is I have a lot of borrowers who are very, very good at raising money, but they've stopped doing that on their own and come to me to do it for them. Because what they found is, even if I charge them 2%, if they don't have to do all the work of raising the money, they can just go find another deal. And they can just focus on what they do best of finding deals. So I'm biased, I'm a broker, but I do believe having a broker is best for both sides. Good borrowers can focus on finding good deals. Lenders can have a second set of eyes that understands the investment side and helps them analyze. So we got borrower, lender.
Absolutely. I mean, you get to bring that expertise in instead of you trying to analyze a deal on your own and hope it all works out. Like it's like not using a professional real estate agent when you go to sell your property. Like it's going to work out better for you if you deal with quality people that this is what they do, and not someone that just I can do this too. I've got a license. It's someone that does this on a day-to-day basis. All right, so we got the borrower, the lender, we got you. Who else is involved in this deal?
If the loan is over $50,000, we're going to need two lawyers. So we're going to need a lawyer that represents the lender's interests and a lawyer that represents the borrower's interests. If the loan's $49,900 or below, you can actually have one lawyer do both sides. But if it's above $50,000, which in today's real estate market, it's hard to do it under 50, you need two lawyers involved. And This is very important. So the borrower's lawyer is going to make sure that, they're not dealing with a loan shark who's got crazy terms built into the contract that's going to bleed them dry and try to, take their property from them via a private loan. And the lender is making sure that there's no hidden. The lender's lawyer is making sure there's no title concerns, that there's no liens from the city or claims. They can look into the property around meth labs, grow ops, previous deaths, things like that. They can really do some due diligence to make sure that we're being secured against a quality asset. So both sides there. Going back to if people are going to go without a broker, not every lawyer specializes in this stuff. So you do want to be careful that you're not getting involved with the lawyer that doesn't understand private lending that's going to kill your deal. And that's from both the lender and a broker side, or lender and a borrower side. Not every lawyer does this. And the second they see private lending, they think, this is risky, you shouldn't do it. Well, there's lots of lawyers who put a ton of their own money into this. So find a lawyer that is a lender themselves, because they're going to be able to give you some additional coaching, some additional insight beyond what just your broker does. So we got borrower, lender, broker, 2 lawyers. And then there's 2 more main key pieces here. So the big one is the appraiser. So first of all, always secure your money. Don't lend on unsecured loans. Always have a registered loan interest on the property. And in order to establish the loan to value, you need a real estate appraiser to go out to the property, inspect the property, run comparables in the neighborhood and surrounding area, and establish a value of said property. So there's a couple ways to do this. As a broker, we order these appraisals. If you trust your borrower and you're okay with it, and you're going to have the lawyer review the appraisal and they understand it, it's not uncommon that the borrower goes out and gets an appraisal on their own. And some people don't like that. I look at it as proactive. If the borrower's out there, they're looking for money. They went and got their property assessed. They've run their numbers. They know what it's worth. Now, as a broker, if the borrower brings me in their own appraiser, I'm going to call that appraiser and grill him a little bit, make sure that this wasn't a chummy relationship, getting a good number down. But
his golfing buddy gave him the appraisal.
That's right. So I'm okay with a borrower ordered appraisal as long as I vet that. But an appraisal is very, very key. Make sure they're designated AACI, DAR, or a couple, but make sure they're a designated appraiser. On occasion, I'll just add this as a caveat, you can't do this for registered plans, but if you're lending in cash, you can use a realtor's opinion of value. So I have done this on occasion, less than 5% of the time, where I know, and I only will do this if I know the market personally, and I know the area personally, and the borrower said, yeah, it's $1 million. I'm like, it's definitely worth $1 million, and we're on a tight timeline. I'll ask a realtor I know to give me an opinion of value. So I wouldn't recommend that as a regular strategy, but if you're in a time crunch and you need something to support the value and you have a trusted realtor, it can be a tool that can be used. Last, certainly not least, this is one thing that's often forgot about, is you need an insurance broker on these scenarios, specifically with investor lending. It's not uncommon that the property is under construction. If you're the lender on the deal, you want to make sure that you are listed as a loss payee on the insurance policy, which means if the house burns down, flood, earthquake, any situation that could happen, that you're named as a loss payee for your mortgage position and the policy pays out to you for your funds. So that's a critical one. And the reason why it's so important is if you're lending to investors, you want to make sure this policy covers what's going on the property.
Wow. I mean, you just mentioned a couple of things there. Like you talked about the investor, why would they go through you? Well, pay for speed is huge, but not just pay for speed, but what if you're going to lend someone money and you think you can do the due diligence that you just in 2 minutes described of, oh, well, I know I didn't get my name on that insurance. I don't even know if he has insurance. And then his construction site burned down. What do I do now? Like, those are big errors. When you're talking, your hard-earned money, this is a big deal to screw up. So I just can't imagine going into one of these deals blind unless I knew the person personally.
And this is such a great point, Darren. And as a lender, this is just like when you're buying a house. You don't pay the real estate commission; the seller does. When you're a lender, you don't pay your broker; the borrower does. When you're a lender, you don't pay for your lawyer; the borrower does. So don't try to cut corners doing this on your own, getting an extra 1% interest on your money without having the proper people supporting and protecting your hard-earned funds, because the borrower pays for it anyways.
The borrower pays for everything. So what would I know I'm sure there's a range, but what would be a typical appraisal cost and typical lawyers for the buyer and the borrower and the lender?
Yeah, so appraisal costs really range, depends if it's a commercial asset. I mean, for a residential property, we're seeing like $500 to $700 right now for just a duplex, triplex type thing. If you're getting into commercial, bigger properties, it really ranges like at $1,000 to $5,000. Like it can be a big range. If you go more rural, it can cost a lot more as well. If you're in a bigger city, you can generally keep that down. In terms of fees, so you're going to have to pay your own lawyer. So typically your own lawyer charges you $2,500 to $3,000 to close the transaction. The lender legal fees can really range. Some of them are more flat fee, $25,000 to $5,000 depending. Some of them on these larger commercial deals for private lending representation are pricing more on a percentage model than a fee for service model.
Really?
Yeah, and the borrowers don't like it and they complain about it. But the truth of the matter is, there's a lot of lawyers don't want to do lender representation for private loans anymore because they don't understand it. It's not their bread and butter. They want to do bank deals that come with clear instructions, and their clerks do it. So private mortgage lawyering, a lot of the times you can't get your clerk to do it. You can't get your assistant to do it. You need to actually do the work on the file. So it's a higher cost. And you're also, as a lawyer, you're taking some reputational risk there. If you rep your client and the deal goes sideways, your client's looking at you going, what's going on? I thought you looked at this deal. So we are seeing a much higher legal cost for lender legal fees. And it's due to risk, reputational risk, if a deal goes sideways.
Wow, fascinating. Okay, so let's walk through a typical deal. So let's like a couple $100,000 loan. What would be the interest rate or range, and how would it set up? So if walk me through a couple $100,000 example.
Yeah, so interest rate ranges right now are in the 11 to 13% range for private mortgages, depending on first, second position. Fees are in the 3% range plus legals. So that's generally what you're paying. 1% of that will often go to the lender as a bonus, and then 2% is our broker fee on this. The broker fee ranges from 1% to 2%, depending on the loan size, etc. We charge 2%. So 11 to 13% on the rate, 3% on the fee, and plus legals as well as the general cost for private mortgages. Keep in mind, this isn't long-term hold money. Yeah. If you can't, and when we're looking at these deals, we want to see that you have an exit strategy within a year, 18 months max. We want to know that there's a plan to get out of this, because we understand that this is not sustainable for you to stay in.
Thanks for listening so far. If you're watching on YouTube, make sure you like, subscribe, and hit that bell button so you always know when new content is coming out. If you're listening on your favorite podcast platform, please leave a 5-star rating and leave a review and subscribe. And if you are interested in learning more, please visit our website at controlandcompound.com to sign up for a free education session with one of our wealth coaches.
Yeah, I mean, it's great. You're 6 to 12 months average. What would be the...
The last couple of years, I say the world's spinning a little slower. We're definitely in I would say the 12 month is the average. It's not on, all of our term lengths are 1 year. We tell our lenders all the time, if we come to you for a 60 to 90 day extension, we expect you to be okay with that. If you needed your money back in a year and a day, you never should have done this in the first place. So if we come to you for 60, 90 days, that shouldn't be a problem. If we start going over that, that's when we talk about new term. So we say to our borrower, hey, listen, this is taking too long. We need to give our chance for our lenders to get out. Or if they want to stay in, you need to pay them a new bonus, because had they been paid out on time, they would have gotten a new bonus and a new deal. So I would say 12, we're right around that 1 year. It's not uncommon to see the smaller projects pay out a little earlier. The bigger projects need that 60 to 90 day extension.
Okay, so walk me through. I'm the lender, so I'm going to loan. You're the mortgage broker, and you have a client that needs $200,000, and I'm going to be the guy providing the $200,000.
Yep.
So from what I have to do on my end, what you come to me and say, Darren, we got an opportunity for 200,000 guys looking for 200,000. What would be? How would you look at that deal and say, we think it's a good deal, Darren? And then what do I have to do in order to get my return, and explain this bonus thing to me?
Yeah. Okay. So just first thing, more of a clerical thing. Before I would even call you to put on a deal, we'd have to have a conversation, make sure you understand private lending, get your questions answered, do a KYC, consent file, look at your net worth, making sure that this is suitable for you. We don't want to take anyone's last dollar. We want to make sure you understand what you're doing, how you're investing, etc. So before that call was even made, you'd have to go through some suitability assessments with us before we even put you on our list of people we call. Assuming that's all checks out, you're good to go. You want to lend your money. So in a scenario like that, we would, first of all, the borrower is going to come to us, and before the borrower can even bring a deal, we're going to vet the heck out of them. So I want to see tax returns. I want to see credit bureaus. I want to see their net worth statement. If they have existing lenders that they deal with, give me their names. I want to know your track record with them. I want to know, do you pay on time? Is there anything I need to know? Is there any risks? A couple of things. We are predominantly equity lenders. So I'll tell you, a lot of the biggest investors in Canada, some people, and we're dealing with some major players in Canada right now, it's not uncommon that their credit score's in the low 700s because they're borrowing a lot. Their credit's getting dinged a lot. So a 700 credit score is still a good score. I don't care about the number. I care about, are the credit cards maxed out? Are the line of credits maxed out? Are there missed payments? As long as there's room and they're not maxing everything out and they're paying things on time, the actual credit score doesn't mean a lot to me as a private lender. I want to more look at utilization. I want to see their financials. And this is something that I got burned on for the first time last year, where we assessed everything and they didn't have their financials done. But everything else looked good. And I did trust this person. It was somebody that I knew and I trusted. Well, turns out that everything looked good except for the major number of unsecured promissory notes that we didn't see.
Ooh.
And that ended up being what caught us in that one. Now, we've been able to protect our investors' first position mortgages, so we're okay there. But it's been a huge headache to deal with. So that's one thing that we are you're not going to beat me twice on that. We are very diligently checking for now is the unsecured debts that don't appear anywhere. The quote unquote P notes or promissory notes that everybody talks about. I want to know what you have unsecured. In terms of lending, there's certainly due diligence of a lender. But on the borrower side, much more scrutinized. We really want to make sure we know who these people are. The example I give is I want to lend to people that if something goes wrong, they're cleaning toilets at night, McDonald's shift in the morning, doing everything they can to pay you back. I like to see people that have grassroots, kids, family. They're not a flight risk in that sense. I want to see that your I don't care about your net income that you're filing on your taxes. I'm not as concerned about that. But I do want to see that your taxes are paid and you're up to date. Mm-hmm. So those are the type of things that I'm looking for on that side. So before you even bring me a deal, you have to pass all that. Once that's passed, you bring me a deal. Sometimes they come with the appraisal in hand and say, I got this property, I've got the appraisal, here's my first mortgage statement, I need a second. Or here's the purchase agreement, I ordered the appraisal already, I need a first mortgage. So once I have that, I'm going to look at the specific deal. Maybe call the appraiser, pull up a purview report, just looking generally at this property. From there, if that passes and I'm comfortable with this deal, I prepare a lending opportunity, which is just a short snippet. This is who it is. This is what they're borrowing. This is how long they need it for. Here are the rates, fees, and timelines that we're anticipating on. And we send it to our lenders via a lending list. That people respond, they commit to the deal. Once you're committed to a deal, we do what's called a term sheet. So we lay out the term sheet of everything that we've agreed to, and we have both parties sign. The term sheet is doing it this way does two things. First of all, by signing the term sheet, the borrower agrees to pay the lender's legal fees. So that's the first thing. Then on the term sheet, it says this term sheet is conditional upon the lender's lawyer review, which means we in order to save a bunch of legal fees on deals that aren't all together yet, we do the term sheet first. Both parties agree to it, conditional upon the lender's lawyer review. Now it's sent to the lawyer. So as the lender, if you sign the term sheet, you're committed to the deal, assuming the lawyer says it's good to go. So from there, it goes to the lawyer. Lawyer pulls title, maybe asks some questions about the appraiser, calls the broker, meets with the lender. Do you understand what you're doing? Do you understand the risks, et cetera, et cetera? From there, we provide instructions. You deposit the money directly to the lawyer. In this type of lending, as the mortgage broker, I will never touch your money. Your money goes from you to the lawyer. Once your money is secured and registered on the property, it is released to the borrower, and your money is not paid. Your borrower does not get the security released on their property until they are paid back in full through the lawyer and released to you.
Okay, so in a year, let's say it's 12%. I get $24,000 if it was for a year. And what about this upfront bonus? How does that work?
Yeah, so if you were getting a 12% return with a 1% lender's bonus, that's the 12% is calculated annually, paid monthly. So that on $200,000 at 12%, it's easy math. It's $2,000 a month. You're getting a $2,000 direct deposit. We used to call it mailbox money, but it's all direct deposit now. So you're getting a $2,000 direct deposit. First business day after maturity. So if it lands on a weekend or a holiday, you get paid on the Tuesday or the Monday or the Tuesday, depending. And the lender bonus. This is paid up front. So if you're lending $200,000, you get a $2,000 check on closing as your upfront bonus. Now, this is done, it keeps the annualized return higher. So if the money gets paid out earlier, it keeps the rate of return, total return up. And I believe in the more olden times, this was supposed to cover your costs. So there was some costs associated with lending. And for those of you just listening, I'm using air quotes here. The cost associated with lending was driving to your bank, getting the $7 bank draft. Then you had to go to the lawyers. So you stopped at Timmy's and grab a coffee. And then you had to go to the lawyer, then drive home. So those are your costs associated with lending. Now, a lot of people just do direct deposit online to the lawyer's account now, so they don't really have costs, but you still get that same lending bonus.
Okay, so you get that up front. Okay, so that makes sense. So now, if it was a short-term loan of only 6 months, I'd still get the full 1% of the loan amount. So that would be an advantageous for a short-term loan. All right, so we talked about how you screen potential people that want to borrow money. Now, I'm sure it's probably the last thing people like to talk about, but I think it could be a really good thing to talk about. Have you had a situation where someone didn't pay, and how did you resolve it? Like, because people are listening, they'll go to here. What's the worst case scenario here? Like, am I going to lose all my money? Like, what's going to happen? Like, what happens if that borrower cannot pay? Something goes wrong. Do you got a story you could share with us for that?
Yeah, so I won't use names, but I do. So we currently have a portfolio of private mortgages that exceeds 9 figures. So we have a substantial amount of private money lent out under our administration. Last year was our first year that we went through some defaults. The real estate market shifted, and as the great Mr. Buffett would say, you can tell who's swimming naked when the tide goes out. We had 2 clients specifically that went bankrupt. This resulted in 5 mortgages totaling $3 million that went that went under. So the answer to this is the first thing you want to do if this happens is marketing the property for sale. So is there enough equity in these properties to sell them and get 100% of the mortgage money back? Because of the market shift and because of the current state of the properties, they were all mid-construction, mid-renovation. There would have been a principal hit had we sold the properties up to about 20%, which means if somebody put in $100,000, they were probably only going to get 80 back. Okay, and in comparison to the rest of the financial markets last year, a 20% hit probably wasn't even that bad.
Yes, that's if I get a lot of clients that marijuana stocks didn't pan out that well, so 20%, no big deal there.
Yeah. So now this is I can't say I can always do this, and I told all my clients this. And in no way is this a promise or a guarantee in anything along those lines. But even with the market shift, the properties that we underwritten were underwritten to do these loans in the first place were solid properties. The money was there, the equity was there. They just needed to be finished so they could be in a good marketable condition. So like I said, for anyone listening, this is not a promise or guarantee of working with me, but in this case, I actually bought all 5 properties from my clients. What they did is they ported the mortgages to me, so I didn't pay them out, but they ported the mortgages to me. I back paid all of their interest, so they were made whole and they were out of the bankruptcy proceedings. And then I actually put myself and 2 colleagues from my team have put in substantial amount of our money to finish these properties and to sell them. So this started in January, where we took over all 5 properties. As of today, 1 of them is already sold. 2 more are being listed next week, and the final 2 are being listed about 4 or 5 weeks after that. Based on the amount of money we've put into them, our lenders are now secured. There's zero concern about return of their capital. And then it actually looks like I might make a little bit of profit, which to me, it's not about making the profit. To me, it was about checking my underwriting. Was the deal still good? Was I right about the deal? I was wrong about the jockey, but was I right about the horse? Right? The jockey being the borrower. These are the guys that there wasn't disclosure around the amount of unsecured lending. So I missed that on the jockey. But for me, getting through these deals and selling them at a small profit at the very least helps me as a check in my underwriting to say I was right about the deal. I knew that these were good deals. I just didn't bet on the right jockey.
Yeah. Well, I mean, reason number 107 to deal with someone that deals with this every day, dealing with an expert. Now you talked about registered money, and people just kind of skim over that. Oh, it's registered money. You put it with a trust and then you loan it. There's a lot more work to it than just that. So if I want to loan $200,000 for my RRSPs or TFSAs, what hoops do I got to go through to make that happen?
So first of all, you're going to have to change the company you work with. So the process that I used to talk about was always, before you move your money from whatever institution it's at, you need to find out who's going to borrow your money, whether that's individual borrower through a broker, whether you're going to deal with a private equity type company. There's some great companies out there that are large firms that deal with registered money and in equity type deals or REITs. So what I always tell people is, before you move your money, find out who's going to borrow your money. I've changed my tune on that a little bit, because there's really one main company that deals with this now in Canada, and that's Olympia Trust. They're the 800-pound gorilla in this space. Community Trust used to do it. They're no longer in it. Canadian Western Bank, I believe, does it at a much smaller scale. I think B2B has a division, but nobody really uses them. So if you're looking at self-directing, Olympia is the main company in this space. I don't work for Olympia. No specific endorsement of Olympia, just to add that. They're just, and this is very important that people understand, Olympia is not a deal provider. They're not a financial advisor. If you move your money to Olympia and call and say, hey, I got my money, what do I do now? They're going to say, you tell me. You tell us what you want to do. We're administrating it. We're holding your registered funds and reporting to CRA that the deals that you're doing are compliant with the CRA guidelines that the CRA allows you to do within the registered funds. They're an administrator of your funds. They're not a deal provider. They're not providing opportunities. In terms of providing the opportunities, that's where you work with a private equity company, a REIT, or a broker, or individual borrowers who know how to take registered funds. Okay? So I will add this point because I hear people say all the time. I'm pretty direct about this. If people say all the time, well, I heard it could take months to get your money to Olympia. If it takes months, that's your own problem. You are the reason why it took months. Okay? And I'll give you the tip on this is what you need to do. And I'm a former financial advisor. I worked in the space for many years. You need to give your current institution direct instructions in writing. So send them an email asking them to convert your funds to a cash position, and please confirm by the end of the day that instructions are received and the move is executed. Then make sure there's paperwork coming from Olympia Trust. Do not ask your current company to push the money. Have Olympia pull the money. Okay? When you send the instructions to your advisor, make sure that you're also telling them, please confirm when you receive Olympia paperwork and there's no errors. This is a big one in the space that, there was errors in the paperwork. That's why it didn't get transferred. So really, and this isn't being rude, this isn't being anything, this is your money and you need to take it seriously. If you're self-directing your money, you don't have an advisor anymore, you're responsible for it. So you need to give clear, direct instructions and following up every 24 to 48 hours to confirming that instructions are received, transfers initiated, and things are happening. I've seen transfers to Olympia happen in 3 days. On average, it's about 10 business days is more often than not what we're seeing right now. But I'm hearing people saying it took me 3 months, 4 months, 5 months. That's your own problem. You're not following up. And if it took you that long to transfer that money, I have some concerns about you managing your money. If you let this go on for 3 to 4 months, are you going to be a good steward of your own money? And like I said, I can be a little critical about this, but that's what you're doing. You're taking control of your money, which means there's not an advisor that you can call and get upset with anymore. The only person to get upset with is you. So,
and you just might be too dumb to deal with.
You said it.
All right. So Kyle, like I said, I met you years ago, and I know you've been working on something for a while, because as an investor, I go in, or as a lender, I go in and I go, okay, I'm going to lend, but you're really taking a lot of, a calculated risk, but you're taking a risk because it's like one person. If that one person doesn't fulfill their obligations, then I'm not going to get my money back, or I'm going to have to go through some hoops to get the money back, like a foreclosure and stuff that we want to avoid. So the idea of spreading that risk over multiple different lending opportunities is huge. But a lot of work and effort needs to go into that, and I think you're just about there, or you are there. So tell me, for those people that don't want to deal with an individual lender, or want to deal with an array of lending opportunities, what are you working on at your shop now?
Yeah, so excited, and even more excited that I've had to refer to it as this elusive thing for a while. I can publicly talk about it now. Our OM's complete, everything's done. We have officially launched what's called CapGap Mortgage Trust. CapGap Mortgage Trust, which stands for Capital Gap, which we believe there's a capital gap in the real estate investing market, people looking to scale and grow their portfolios. And our fund is designed to help investors get stabilized rates of return secured on real estate. But it also is designed to allow our borrowers to borrow, grow, and scale their portfolio faster. So we're super excited about this. I'll be the first to admit some of the downside to my current model, and we're still going to operate our current model. You can still do individual direct private lending. That's still going to absolutely exist. But some of the downsides are You pick a deal, and then you have to wait for the deal to close, and then when the deal pays back, you got to find a new deal, and there's downtime between deals. In the CapGap Mortgage Trust, there's no longer downtime between deals. It's diversified across a pool of funds, a pool of mortgages, so you don't have to individually pick your deals anymore.
What about up front, Kyle? When you guys are raising money, you're not going to, isn't the money going to have to sit there a while before it's deployed?
This is what we call the CapGap edge. We are in a position where we have a very large portfolio of open mortgages sitting there waiting to be paid out by our fund. So what this means is when we take a tranche at the end of the month, whatever amount of money comes in, if it's 3 million, 5 million, 10 million, we have mortgages sitting there waiting to be paid out. So there will be less than 24 hours between when we raise the money, it hits our account, and it goes out.
Wow.
So this is what a lot of people talk about. I have a fund. We have money. We have millions of dollars sitting there. That's not good. You don't want money sitting there. You actually want very, very, very low bank balances in a fund model. You want all your money out earning interest, paying return. So by having this open pool of mortgages sitting there, this is allowing us to skip the ramp up period. When we take new money in, at the end of the month it comes in, first of the next month, we have open mortgages sitting there for refinance, ready to roll so we can start paying returns to our investors the next month.
Wow, that's awesome. Now, what type of lending are you guys going to do as a fund? Is it the residential stuff? Is it first position? What are the options? What's the risk tolerance sort of for investors when they're looking at this?
Yeah, so I guess I should add here, I got to do my disclaimer before I get too much into this stuff. They always seek independent legal advice before investing. There are risks involved in all investing. I would just want to make sure that everybody understands that. We don't put a lot of work into this, but I always got to put that disclaimer out there. But we have three different tiers. We have a first tier of first position mortgages that can't exceed 80% loan to value. That's an 8% yield target for our investors. We have a second position fund, a second tier fund that will do first and second mortgages up to 90% loan to value. We likely won't go to 90 that often, but we do by the letter of the OM have the ability to. That is an 11% yield to our investors. And then finally, we have our construction fund, our third silo, which is a 14% target yield. This is lending short-term construction financing. With that portion of our fund, we have the ability to lend on future value. So those are deals where they're going to spend significant money in value add increasing. So those are the three yields and types. Happy if anyone wants to chat more about this. We're happy to have an initial conversation. We'll introduce you to our EMD. They're going to go through all your suitability, KYC, accredited, eligible, make sure that this is right for you, and make sure the amount you put in is appropriate.
So that first tier, like that first position, so you got a first mortgage on all those ones that have an 8% yield is what the fund pays.
Yep.
So like first position, like there's no other more. You if that house has to be foreclosed on, you get first dibs.
That's right.
All right. That's not if you're an experienced real estate investor and you believe in the whole real estate model, that's an incredibly low risk one. And then even the first and second up to 90, you're not talking just, hey, I need some money. Can you loan it to me? Like these are first and second positions only going up to 90.
And just to add to that too, when we're going to 90 on a deal, that's up 90% of the as is value. These properties are being strategically renovated. We're lending to investors who are putting more capital into the property to drive the value up. We have several deals over the past year where we lent at 90%. And this isn't the real estate market in the last year, which went down. It's coming back a little bit now, but we lent at 90% of the purchase price last February. So right at the peak. And some of these properties are coming back now a year later. And the mortgage that was at 90% is now at like 60% loan to value because it's been increased so much via strategic renovations. And even though the market as a whole went down, the townhouses and subdivisions went down. Single family homes went down. But do you know what didn't go down? Rent. Rent went up. And if you're buying an apartment building or an asset that's valued based on the income, you did not see the same depreciation as a townhome in Kitchener or a single detached in Brampton. You were seeing the apartment buildings in Chatham went up because the rents went up.
That's incredible. Okay, so CapGap Mortgage Trust, KyleFordMortgages.com. KyleFordMortgages.com. And then any other sites that they can follow you, learn more about private lending, learn about CapGap Mortgage Trust. Where's the best place to check out you?
Yeah, CapGapMFT.com stands for Mutual Fund Trust. CapGapMFT.com, KyleFordMortgages.com. Kyle at CapGapMFT.com is my email. Shoot me a note, and I tell people all the time, Google me. I've done lots of YouTube talks, videos, podcasts. I'm all about giving back to the community and sharing what I know. So many people did it for me, and I'm happy to do that. I'm not a coach, so I don't do coaching, unfortunately. But if you are looking for help in the mortgage business with conventional mortgaging, reach out to my team, and I got some great agents that can help you with that. So
that's awesome, Kyle. It's so nice talking to someone who's an expert in what they do. Love to talk to you. Look forward to getting you back, hearing more about this new mortgage fund. Unbelievable. Thank you for listening. Thank you for watching. Have a great day. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.